Okay. Good evening, everyone. Uh, we did up to forecasting of financial statements. We forecasted the P&L, we forecasted the balance sheet, we prepared forecasted cash flow statement in the previous case. Now, going forward with the next step in equity is equity valuation. So we are starting with the valuation part, but not fully. Initially, few cases will be understanding of the terms which will be used in full-fledged valuation. So we have this case 7. Let us read what they're saying. As an analyst, you have been inducted in the corporate finance department of TCS Limited. Okay. Your team lead has proposed to raise funds through a FPO recently, and he has asked you to evaluate the probable impact of the same. The impact of this FEO was to it is going to impact basically capital structure and your WACC. Okay, weighted average cost of capital. You are requested to calculate WACC. We will see how to calculate WACC. It is weighted average cost of capital. The company's capital structure is made up of equity and borrowed, so they already have some sources, some equity money and some debt money. The extract of the balance sheet reveals the following information. So equity fund is 736, borrowed fund is 2624. You have collected the daily stock prices of the company and Sensex. This will be used to find out the beta of the stock, because for finding WACC, I need to find out what is the cost, what is WACC, weighted average cost of capital. So if I have 100 rupees of capital in my business, then what is the cost of raising that 100 rupees? So that 100 rupees, like if I say if I'm raising, if I have 100 rupees of capital, what is the cost? So there can be a combination, like I may have 60 rupees of equity in my business. I may have 40 rupees of debt in my business. So if I have 60-40 ratio, then whatever is the cost of equity, whatever is the cost of debt, multiplied by this respective weight, I will get the weighted average cost of capital. How do I get the cost of equity? Cost of debt is much more simple to calculate, because debt comes with a fixed obligation of interest. So how do we get the cost of debt? We say cost of debt is whatever interest payments we are doing. But you have to understand one thing: whenever you make any interest payments, that interest is a tax deductible expense. So that is allowed as a reduction from your income. So in that case, if I'm paying 10 rupees of interest, that 10 rupees is allowing me to save 30%. I'm assuming a 30% tax bracket. So this 10 rupees of interest is allowing 30% of 10 rupees to be saved as tax savings. So net cost what is incurred is 70% of that 10. Again, I repeat, if I give 10 rupees of interest, so this 10 rupees becomes my cost. My income will reduce by 10 rupees. And because of that, once your income reduces by 10 rupees, your tax will also go down. So the cost of debt is nothing but interest into 1 minus tax rate. Means after reducing the tax benefit, remaining part will be your actual cost of the business. This is your cost of debt. For cost of equity, the problem is, first of all, this is cost of debt, sorry. KD is cost of debt, KE is cost of equity, K is a symbol for cost. Cost of equity is very difficult to calculate, because there is no fixed obligation of any kind of returns to equity holders. So it is very difficult to say that this is the cost which the company is incurring for equity shareholders. And in that case, what do we say? Whatever the investors are expecting, whatever the equity shareholders, whatever they are expecting from the company, that as a company, I need to give to them. So if they are expecting, say for example, 15% return, just for example, if shareholders are expecting 15% return, then ideally as a company, I have to give them 15% return, or else they will search for some other company, or I have to give them more than 15%. Then that is nothing but my cost, because if I have to give them 15% returns, for them it will be returns, for me it will be my cost. So for cost of equity, we generally go for the expectations of shareholders. How do we get that? How do I find what is the expectations of shareholders? So let us see what are the possible options with the shareholders. First, they can invest the amount into government securities. Government securities will give them less interest, but they are secured. Their money will not be lost. So say for example, government securities are giving 4% return, for example. So if equity shareholders decide not to take any risk, then risk-free return what they can get from the market is 4% through government bonds. But if the company is investing in shares of a company, of course they will expect more than 4% because they are taking a risk. If the company, of course, a company is going to be more risky than the government. So if I'm investing in a company, that means I'm taking that risk. I will take that risk only and only if the company and the markets are giving more returns than this 4%. So they want something in addition to this 4%. Second option, what the company or what that investors could do is they could invest in the market. And say, for example, market is giving 10% return. Market is giving 10% return. So basically, market is giving 6% higher than the risk-free return. Market is giving 6% higher because 4% investors would earn anyhow. But because they are investing in the markets, they're earning 6% extra. So yeah, second alternative is for taking the risk, they could go for the market. But they are coming in your company, of course, they would be expecting returns basis your company in the market. Like if your company is more risky than the market. When I say market, that means the index. If your company is more risky than the index, then they will be expecting more than 6% extra returns. 6% market is giving extra. They will expect more than 6%. If you are less risky as compared to the market, then the investors might be happy with less than 6% also. So that riskiness of a stock in comparison to the market is nothing but beta. Say for example, if beta is 1.5, just for example, if beta is 1.5, that means the stock is 1.5 times risky as compared to the market. That means if market goes up by 10%, stock might go up by 15%. But other way around, if this market go down by 10%, stock will go down by 15%. It is very risky. So that time, the investors might be needing more than the 6%. So for that, we say, let us see what is the expectations of the shareholders. They are saying they want minimum RF plus. They want more than market returns also. So market is giving extra 6%. They're saying the stock is risky, so we want more returns. If the stock is 1.5 times risky, means 6% the market is giving, 6 into 1.5, 9% they will be expecting from the stock. And plus the 4% what anybody would achieve. So 13% will become the expectations of the shareholders, which will become the cost of the company. So for finding that beta, we need these prices. Okay. Uh, the current debt has a interest cost of 196.8. Okay. So this is the interest on the actual current debt. Your finance manager wants uh, basically he has asked you to develop a financial model using data validation to compute the WACC at different tax rates. So there are various tax rates given to you. And they're saying for computing the cost of equity, the RF can be taken at 8.59 using data validation. In input, I'm putting whatever I know. So what things I know right now is that this is the existing capital structure. This is the existing capital structure. This is the existing capital structure. Okay. Then, uh, interest cost. Interest cost is 196.8. I'm just jotting down whatever is given in the case. Okay. Then you have income tax rates, IT rates. 30, 33, 36, 40. So 30%, 33%, 36%, and 40%. And you have RF, risk-free return. Generally, government bonds are used over here, 8%, 8. That also depends upon what kind of bonds you are taking, what is the time frame. Some people take a recent, some people take last 5 years average. So it depends on case to case. How are you going selecting this risk rate of return? Now I am about to find out the beta of TCS. Means I want to find out how much TCS is risky as compared to the markets. So for that, I'm doing a small working over here. Calculation of beta. First, I want to find out returns of TCS and returns of Sensex. What do I need? You can do one thing, you can just copy this entire chart. This is for 1 year. You can paste it over here. I'm adding two columns to this. One is TCS returns. Another one is Sensex returns. Sensex is market. Okay. How to get TCS returns? So can I say TCS has closed at 2892 on 13th of March and it closed at 3051 on 12th. Means in one day the price change has resulted into a negative return of 5%. Anybody who might have invested on 12th of March at the end, if he sells at 13th March at the end, of course, there's going to be a loss of 5%. Okay, so I can do this and find this for all the days, and same thing I can do for market. Okay, and now I say I want to find out a beta. Formula for beta is in Excel we have function called as slope. Slope function will use will use this calculations and they will tell you the beta of the stock. I hope up to this stage we are okay. Okay, so how do I get it? Slow. Known wise is the returns of y is the dependent thing. It is the stock, and x's are independent. Independent means the market. TCS is dependent on the market. Market is not dependent upon TCS. Beta comes to 0.11. 0.11 means whenever there is 1% change in market, TCS has a change of 1, or I will say 0.11%. So TCS is less risky as compared to the market. If TCS is less risky, then the expectations of the shareholders will also be less, because if you are taking less risk, you are happy to get less returns also. So the model, let us find out weighted average cost of capital. For that, what I need cost of equity, I need weight of equity, I need cost of debt, I need weight of debt, because WACC will be equal to, okay, weight into cost. Let us see how to do it. First, cost of equity. For cost of equity, the formula I gave to you was RF plus beta into RM minus R. So I say RF is equal to, it's coming from here. They have asked us to have a data validation on RF. Okay, so let us first do one thing. Let us do the data validation over here. Go to data tab over here under validation. You will show a list. The sources in the input RF. So I will have a drop. Okay, then beta will be coming from here. Okay, then RM is market return. Market return, you can take an average. Let me see whether I have done the calculation on here. Okay, let's take an average one. The average of market return is this. So I will get an average return given by the market. And KE now will be equal to RF plus bracket open beta into RM minus RF. Around 7.11. Around 7% is the expectations of, and it is actually, the numbers are a bit, because these are what I will say, these are hypothetical numbers. Generally, we will not expect below RF, and generally RF is not so big also. So generally RF is 3 to 4%. So this number makes sense. Around 7.5% the investors are expecting from this company. Okay. Now impact. I want to see the weight. How do I get the weight? Weight is nothing but weight is nothing but the total value of equity, which is this divided by total capital. I want to find out the weightage of equity in total capital. So around 20% is your equity. Now, cost of debt. Cost of debt, I told you it is what? It is interest rate into 1 minus t. Interest rate is interest into 1 minus t. So, interest rate is equal to, and I say interest rate will be nothing but interest cost divided by the borrowed funds. This is the interest cost what you are bearing, around 7.5%. And tax rate, for that we have to use again data validation. So data validation, in that I take a list and an input. Source when I say input, tax rates are these. So I have a list of tab. Just a minute. List is, oh yeah. Okay, you can take any rate right now. And KD will be equal to interest rate into 1 minus tax rate, around 5%. And I have to find out weight of debt. Weight of debt, like we found weight of equity, will be debt upon total amount invested in the business, around 70. Of course, it is 21 is going to be the remaining part. So weighted average cost of capital is equal to cost of equity into weight of equity plus cost of debt into weight of. So around, for raising this amount, whatever it is, to 736 and to 3361. So when the company is raising 3361 amount, the average cost incurred is around 5.65%. And why this is important? When you are selecting a project in which you want to invest, then you will be selecting only such projects where the returns are more than WACC. When I am going to park this 3000 rupees crores, I would be parking it in such projects where I will be earning more than 5.65%, because then only I can satisfy debt holders and equity holders and get something in surplus with the business. So if a project is giving you 4% returns and your cost is 5.65%, you will not go ahead with the project. But if the returns are 7, 8, 9% from any project, then yes, you can think of going ahead because you will be getting something extra over and above the cost of capital. So this is a very important parameter which will help us evaluate which projects should go forward, or companies evaluate which project they should go forward with and which project they should not. Okay, so I hope this case was understood. We will discuss the next step in valuation in the next video.